So what do you think is going to happen? Our situation will be this way. I think in the market, for it to try to be able to return back into a recovery situation, we'll have to go through three phases. The first is what we call a selling capitulation, which we'll probably have already started. The selling capitulation I'll explain in a little while, but that's normally a very aggressive type of selling condition. Then it will go through a bottoming process. And the bottoming process, I will try to describe to you different types of bottoming types of patterns so that you can be familiar with what they look like. And so if you see them in some of your stocks, that you can be quite ready to be able to respond. And third, it will go and confirm a trend reversal signal. We're way off from this right now, but again, we need to know whether things have already cooled down and whether the market is already deciding to be able to start to recover well and more lastingly doing so. So we will talk about what a trend reversal means and what we can look at to be able to give us a better view that this is actually taking place. So let's begin with the first particular phase or step. Now, capitulation. Now, capitulation is, in a sense, panic selling. People ridiculously selling their positions because they're fearful of the general market condition. And no ounce of explanation is going to try to tell people to hold on to a stock when there's just so much problems around you that could be threatening, maybe in this case even life-threatening. And it's because of that that people have been liquidating their positions with quite heated impact. And given that particular type of situation, you want to make sure that people are behaving quite emotionally here. And when people are selling, even at these prices, they're just really want to stop the bleeding. They don't really care about what the fundamental value is. They need to be able to raise some cash so that they can feel safe during this troubled times. And they're literally just selling things quite ridiculously already. For those who can take advantage of that, I mean, this is the time that you should be extremely watchful of any opportunity that can come from this situation, because this happens maybe once or twice in a lifetime. And given this context, this could be one of those opportunities we're looking at. Now, when we talk about capitulation, capitulation is not a single drive of a decline. It could take, a few accelerated portions coming through it. If you notice the picture that I put out here on globe, I wanted to show you that as the decline usually begins, it starts off at not so aggressive pace. Then it becomes a bit faster, and then it really becomes fast, even if prices are much cheaper. Again, it's not because people don't think that the market is cheap, it's just because their ability to hold is being compromised by the fear that they're actually feeling. And you can clearly see it because you can see that it's already becoming quite intensified, almost vertical in its decline. And that's very typical of what a capitulated selling would look like. And you will see this series of declines that would come into it. Now you might ask, what do I do in a situation like this? If I could turn time backwards and tell you, of course, better to lighten down already so you don't have to be able to make decisions in today's type of situation, I mean, that would have been, of course, a better cast. But we're currently in a situation perhaps looking at something like this. And given this situation right now, you really have to ask yourself is, do I have what it takes to be able to hold the position through and through? That you firmly believe that the valuations here are clearly much higher and that this is going to be a temporary event. And if you do that, then perhaps you might decide to be able to hang on to that. I'll talk about that strategy later when we decide whether you're short-term in terms of your ability to hold or whether you'd be long-term in your ability to hold. Now, what do we do? Technicians normally are trained to be able to stay out of a decline. And there's good reason for that. In a decline, it goes through a series of ups and downs and price pauses like this. And it looks like it may have been over in those two situations just like this, but then you'd see again prices will come back down and accelerate into the decline. One tool I'd like to use and introduce to you to be able to help navigate through this are moving averages. Today I will show you the 20-day exponential moving average compared to the 50-day exponential moving average. With everything I'll show you today, I'll just show you these two and try to be able to help you use them so that it can help guide you as to whether you should be staying out or coming back into a market. In essence, moving averages are good trending indicators. If you see them, what they're doing here, you can see prices falling down, and you can see that prices tend to be staying below the moving average, the 20-day, and even the 50-day moving average. As long as prices stay below these particular moving averages, the tendency for you as a trader is to be able to stay out of that market because it tells you that the downtrend remains intact. So when you're using this 20-day moving average versus the 50-day, as long as you don't see the 20-day cross up strongly over the 50-day and you just see prices staying below both, then the basic assumption here is to be able to stay out of the market. Now, if some of you are trying to be able to buy for a very, very short particular bounce, and you're thinking a grossly oversold situation like this can probably rebound well to make some good money in the interim, well, you can try to do that, but I would suggest that you do that with very, very controlled levels of volume. First, if you buy too much, you might not be able to survive the trade because a little pullback and you might get scared and you might toss it away. Second is also try to mitigate what you were anticipating as a target. Normally, if your price is down here and your moving averages are, let's say, above at this level or at this level, you should only be targeting either this or this as a potential rally, and that being the best of the situation. If you can see here, rallies were actually quite blunt, and only because people were able to buy at a very low price. Rallying this distance, some of those guys are taking in good percentage gains at this. So it does take some time to be able to get away from a decline such as this. And it is a process of bottoming out, as we will explain to you in a while. So the process of bottoming in terms of our market will probably show itself in a few forms. We'd like to be able to put some letters into these types of forms so that you can generally get a sense of how it can be easily described. So three bottoming processes. Let's call the first a U-shaped bottom. The second will be a V-shaped bottom. And the third will be a W-based bottom. Let's look at the first. Now the U-shaped base looks like this picture you see here. You see a downtrend, slowly slowing down, eventually going sideways, starting to get a bit more firm, and then eventually turning itself up and then moving back into an uptrend. Now this U-shaped base is a clear anticipation of a market that perhaps is not seeing a very rapid sense of a recovery. And this could be the case in our market because we don't know how fast that they'll be able to fix the problem of this plague going on. So what will happen here is we could probably get this type of impact. So if you look at a sample of MegaWorld in the past, you will see very sharp drops. Again, capitulation, a little rally, capitulation, a little rally. And here you can see a much more good orientation in price. So the minute you see that the volatility of the price seems to be narrowing down, that means that the range of the trading for the day starts to be no longer 5% or 10% in a day, but maybe goes back to normal in the sense of maybe under 2% or 1% in a day. And that tells you the market seems to be calming down. And if you notice in this U-shaped type of pattern here, you will see this gradual decline that will come in. No longer an intensification or an aggressive decline like you saw in the prior one. This will be your first clue that the market seems to be orienting itself and is getting an avenue of safety. And this is what you want to see in a U-shaped type of pattern that can prepare you that an eventual recovery and a more lasting one will actually come in. Now, a variety of this type of bottoming type of pattern is what we call a V-shaped base. Now, it's called a V-shape because a V is much more sharper than a letter U. Where a letter U is much more gradual in its turn, a V-shape will show you a very, very, very sharp recovery after this capitulation had taken place. Commonly, a V-shape will look like something like this. You will see that the V-shape will move gradually first, accelerate down, and more likely in the case of the V-shape, it could be because governments are introducing stimulus. It could be that maybe some bright scientists out there may have figured out how to be able to solve the problem or even introduce a cure for COVID-19. And that could be a good reason why you probably would anticipate a V-shaped type. So there has to be something that will change the landscape that will cause the V. If it's not there, then more likely a U or W-shaped type of bottom will take place. Now, as an alternative of a V-shape, you could have something in the middle. This is what we call a square root type of pattern. It starts off like a V, sharp rally, and then it positions itself with a graduated decline, pretty similar to what I showed you earlier to the U-shaped pattern. This, again, as you see that the volatility tends to be a bit less wide, and you see that it seems to be more in control, that tells you already that a lot more people are starting to buy their positions back into the market, and you should prepare yourself for prices to be able to move upwards right after that. Now, sometimes taking in the first type of V-shaped pattern may be very difficult. One, it comes as a surprise. Two, it hardly pulls back. And it's because of that that V-shaped type of bottoms will have to introduce something more aggressive into the trader. You have to put in a little claim in there, never mind if you're not fully positioned, but you want to be able to take an early claim into that as soon as the V-shape is coming in. And normally you will know that the V-shape is probably going to be quite extended because you will see that the price will start breaking above the 20-day and the 50-day moving average already. By that time, the market is feeling much more confidence. And with that confidence will come greater demand. And as the demand becomes much more lasting, then you will see the V-shape attempt to be able to be more elastic than what it was in the prior type of bottom. Now, the final type of bottoming process is what we call a W base. So W base, because what it does is that, again, it's also gradually oriented. There could be some news of a cure, or there could be some news that we're getting close to a cure, but it still leaves a certain period of uncertainty. Or they may tell you that perhaps a cure may be coming out, but we can only expect it into the next year or the next 18 months. Clearly, that could have its own level of disappointment. And so these conditions, because it will still drag onto the economy, you will see that the first rally from a W base will probably come, perhaps create a small W in its first rally, and then come back down to retest the previous low and complete the double base of a W pattern. So if you look at the Metrobank picture we have here, that shows you quite a good sample of what that looks like right there. And so after it does, and it completes a two-level test of support, and then you can see a much more viable option to be able to get in hand. Let's go back to the use of the moving average. If you remember what I told you earlier, if the price of the stock is trading below the 20-day or the 50-day moving average, I told you, more likely you probably want to stay out. Also, if the 20-day moving average is not crossing over the 50-day moving average, it also does not sponsor the idea that you're getting a buildup in demand so much yet. And that's why it's only at this point here where you see that the short-term moving average, the 20-day, crossing over this longer-term moving average, that you see a much more viable trend action come back into a recovery swing. And this eventually is what we're going to be keeping our eye on. The minute we see these crossovers in the 20-day from the 50-day come in, it will produce a much more lasting rally for you, and you can probably trade this with greater confidence. If you're trading the first rallies, looking into it, you will just have to trade it, keep that in the short term, because there could be a second attempt to be able to test support. But after the second test, and you have a combination of indicators working in your favor, you will get a much more substantial impact into the rally of the market. Now, once the market shows you a V-shape, U-shape, or W-shape, and you do get your crossover on your moving average, we will start to see some telltale signs of the market's uptrend is starting to stick. You will see higher highs and higher lows present themselves. The crossover in the moving average will also give you good inclination to keep the positions in a longer period of time, because you have to understand that after a massive sell-off like what we've come through, the advances that's going to come next is going to be quite substantial. And that's why try to be able to prevent yourself from just taking it or selling your positions outrightly. If you want to sell, keep perhaps half or 30-40% of your position, because the advance that's going to come in the next few months and maybe even the next few years can be quite substantial.